Welcome to the daily update, where I'll go over the action in the market for Friday, August 1st, and we'll see how things look for Monday, August 4th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, not a good day on Friday. We've actually turned over to negative in the short term. We've dropped below the 20-period moving average. And the employment report was disappointing, much weaker than expected. And the numbers from previous months have also been revised down. It's like, okay, the market trades off of this stuff, and then they come back and they change the numbers around, and it's like, okay, we weren't really expecting that. We thought things were going better than they were. The unemployment rate ticked up a little bit, and we had really strong numbers earlier in the week from some of the other employment data. The initial claims and continuing claims were steady, but the initial claims came in weaker than expected. But the report, which is probably the most important economic report of the month, came out, and we were already negative. And you've got a lot of the tariffs kicking in now, that with countries that didn't come in and make some kind of a trade deal. And it's not like this was a surprise, but we're also coming into a more seasonal weak time of the year. Now, the last couple of years, this started about halfway through July, and that's what I've been pointing out, and I did another video about that. Is it happening now? We have switched over. We're looking more negative. The market is turning more defensive. Okay, so right at the open, we had a huge gap lower, and we actually went immediately below S2 at 62.65. We've been dealing with the 6,400 level, and in Thursday's session, we opened above that, came down, and then it acted as resistance, and then we fell down from there. We're far away from that now. We're into the 62 area, and I have to turn on my pointer here. And so there's some weakness that's coming in, but we were able to find support at the 62.15 level. As near as I could tell, that was a support level for the Dow, and we seem to kind of settle right around that area. And then we tried to rebound. You had to buy the dippers. They're trying here. But then we hit resistance at R2 because we had fallen below. I'm sorry, this should be S2 here. And then spent the rest of the session just chopping sideways. So a lot. And we've seen that. Back to last spring, we would see these gap lower opens. And then the market would gyrate a little bit, but not move all that much while the session was open. As we were going up, the futures might be more subdued, and we've been seeing more of the price changes actually coming during the cash session. All right, so we were down 1.6%, the first time in quite a while now that we've seen more than a percent move, either up or down. And we were above average with volume. There was a lot of participation there. Now, we've turned negative in the short term because we're below the 20-period moving average. We're seeing some weakness coming into the intermediate term as well. The long term still looking okay, but naturally some of our longer term indicators are showing a little bit of weakness there. But right now, this just looks like a pullback. And we're just coming off of setting recent all-time highs and folks wanting to take some profits. We're coming into a more negative seasonal time. You put all that together, you come out with this employment report, and the market just kept going down even after the open. So interest rates did drop. We're getting further below that 4.5% level, and I'll show you that later on. And now, all of a sudden, because of these weaker economic reports, you're saying, okay, maybe the probability of going into a recession is actually increasing a little bit because that's the area that's been holding up. All right, so some comments. Higher tariffs, they did kick in for a lot of countries. These were the countries that didn't make a trade deal. This includes a 50% tariff on Brazil, 35%. We've been good friends for a long time, but we're kind of going through a rough patch over the last year or so between the US and Canada. And it was raised up from 25%. Now it's 35% for Canada, 25% for India, also a pretty good friend of the US, 20% for Taiwan, and 40% on all transshipped goods, regardless of where they came from. Because there's some maneuvering going on. They're trying to get around some of these tariffs and be a little bit creative with how they're going to do things. And so they just said, all right, 40%, no matter where it came from. And then the employment situation report, much weaker, and the previous months were revised down. ISM manufacturing, also weaker than expected. President Trump fired the Commissioner of Labor Statistics, citing revisions and alleged data manipulation. I mean, these numbers they usually revise, but not this much. And of course, if you like Trump, you think this was a good move. If you don't like Trump, you're going to call him Hitler or something. So then Fed Governor Adriana Kugler is resigning from the FOMC. That usually doesn't happen very often. And it'll happen August 8th. President Trump will nominate her successor. Okay, so that's one thing that's happening. And we're back above 20 with the VIX. This is when we see negative annualized returns. The VIX had been rather subdued. We were getting down into the 15 range. Now we're back above 20 at 2038. And value held up better. Now we've been seeing this. If you go way back to the first day in July, a couple of days, a number of days along the way, we saw the market potentially getting more defensive. And even though value was down, it wasn't down as much as growth in Friday's session. Parabolic SAR and a lot of our intermediate term indicators are now looking more negative. But a primary indicator that I follow is the parabolic SAR, which is now negative as well. Now we still have the stochastics. It's the long-term stochastic, the long short-term stochastic, but we're really coming down in the short and intermediate term of that chart. And we did really spike up with the VIX. So now the RSI, based on 9 periods, that measures how fast the VIX is moving, that's already extreme. And now we have the Stoch RSI, women's percent R. Just a few days ago, these indicators were on the extreme positive side, showing good momentum. And then one of the CCI charts, the CCI 14, but not the 20. And notice this, we have an extreme positive reading on one hand, we have an extreme negative reading with the stochastics chart on another, and then the force index. And I'll go through that a little bit more when I get to that chart. And then intermediate term, we have the McClellan oscillator for the S&P starting to get extreme negative, and the Connors RSI, which is not an indicator that I show very often in the daily videos, just when it gets extreme. Intermediate term, we're still looking positive, extreme positive with the momentum oscillators, but they're below their moving averages. So they're negative, but still giving extreme readings there. No change with the overall Fed scenario. They're just kind of waiting to see how things play out. And it's kind of interesting because there were a couple of dissenting voters at the meeting that was announced on Wednesday who thought there should have been a rate cut. And the Fed gets this data before we have it. I mean, we all see it at the same time, but they get this, they had this employment data at the meeting. You know that. I mean, it's not like these reports are put together and they just sit on a shelf and remain secret. No, there are people that know about this ahead of time. And now it's making those two that voted for a rate cut. It's like maybe the Fed should have done that after all if the economy is really looking weaker. But we had GDP earlier in the week, and that was stronger than expected. All right, and then the dollar was down. It had been going up. We were getting back above 100. It took a big dive in Friday's session. And then interest rates were down. You're seeing a little bit of flight to safety. We're seeing some economic weakness now. And we were at 4.36% after Thursday. We went all the way down to 4.22% for Friday's close. Sentiment, we're back down to neutral. Just a couple of days ago, we were in the mid-70s. That's when we're looking extreme. We were at 63 after Thursday. We fell all the way down to 50. So people are getting mighty nervous, mighty quick here. And yes, the market probably overreacted in Friday's session because it's like everything got taken out on Friday. And now in the short term, we're back to not trending. because we're dropping below the moving average here, and we're negative. The red lines are starting to cross above the green lines. That's both the short and intermediate term chart. And the bias is negative since we had quite a down day. And the momentum, I've switched that over to negative. We've been seeing some weakness coming back in. And momentum is the last 2, 3, 4, 5 days taken together. All right, economic reports. Now, these are government jobs, but they've been the headline number. And remember Doge? Remember the cuts? Well, a lot of those people didn't show up on the statistics because they got a severance package. Now that that severance is gone or used up, now they're going to start coming into some of the statistics that we see. But they thought there was going to be 102,000 new jobs. There were 73, so that was weaker than expected. But what's really shocking, when we had this report a month ago, 147,000 jobs were reported. They revised it down all the way to 14,000. That's a big revision. Now, the private payrolls, this is private, this is where most of us probably work, also weaker than expected at 83,000. They thought it would be 110,000. And when we first got the report, 74,000, they revised it all the way down to 3,000. Again, a big downward revision. And apparently this is part of the reason why Trump said, okay, whoever's keeping all these statistics, the leader, you've got to go. Unemployment rate, 4.2%, where it had been at 4.1%. That was as expected. The average hourly earnings came in as expected, up 0.3%. Last time it was up 0.2%. The work week ticked up. People are working a little bit longer, 34.3, where last time it was 34.2, and that's what they expected. Construction spending, again, weaker than expected. They thought it would be up 0.1%, down 0.4%. Last time it was down 0.4%. Then the global U.S. manufacturing, under 50. Last time we had this report, it was at 52.9. That shows expansion. When it's under 50, that shows contraction. And then this was the other big report, the ISM manufacturing. It came in weaker than expected too, at 48. Again, below 50, showing contraction. They thought it would come in at 49.5, and that is below 50, but they thought it would be doing better. Last time it was at 49. Consumer sentiment. People are feeling about the same as what was expected, 61.7. Last time it was at 61.8. Okay, so here are some charts. I don't show the job number charts, at least with my own charting software, because you get the skew from the COVID lockdowns, and it makes those charts pretty much useless here. I show them in a little different way where I get them from briefing.com. But we are seeing a little bit of a tick up in the hourly earnings on a year-over-year basis. That could potentially be inflationary, but that's also good if you're a worker making some money here. And then non-farm payroll change. It was up, but you see this number was much higher and they revised it down. And now it's like, okay, a month from now, when we get to September, are they going to revise this number down as well and go back and revise some of these other numbers to be even lower than that? That's the fear that's starting to come in. Construction spending is ticking back up, but it's still below zero on a year-over-year basis. Private construction, residential ticking up, where we have non-residential ticking down. Both are still below zero. Then construction spending month over month, it was negative, but it did improve from the previous reading. Then the ISM manufacturing, total reading, ticking up, but still below 50. It's pretty much flat right now. Where the orders are moving up a little bit, that's also still below 50 with the yellow line here. And the deliveries here, the blue line, pretty much flat, coming in pretty hot right here, and ticking up just a little bit with the yellow line, the deliveries. And then the imports and exports, they're ticking down a little bit after both of them had been coming back up. Then the ISM index, still below this dashed line, which is the 50 level. All right, then switching back over, we did get the initial claims. That's the red line. If you look at the moving average, which I don't have on here because there would be lines all over the place, that's still going down. The continuing claims are still elevated, but they're below that 2 million mark. And now we've had a tick back up of the unemployment rate. Then the consumer sentiment here, the total reading, it is improving. That's the blue line. And then how people are feeling right now is the purple line, a little bit better there. And a little bit more cautious. It actually went down a little bit when you look out into the future. Here's the chart that I have, just comparing it with the 2-year Treasury yield, where we typically have been improving after it really was falling off. All right, then some other charts. Real investment advice. Advanced real, that means inflation is calculated into this, retail sales. Now, we had a really strong report when that came out, but it's not really rising all that much. And this is quite often what can happen before we go into a recession. Then the heavy truck sales also continuing to decline as well. And then the market suffers when hedge funds. Now, as I usually say, the hedge funds might be big money. They're like really like mutual funds on steroids, and you pay a lot more for management fees, and you have these rock star hedge fund managers. It always interests me when they say, yeah, this is a former hedge fund manager. Well, if that person was so good, how come they're a former hedge fund manager? Why aren't they still doing it right now? But they've been going short on the market. Now, they do have an impact on the market, but they're not necessarily the smart money. And then retail, that's you and I. These are people that we do our business through a broker, and we're considered to be the public here. We've been seeing a lot of folks long the market, but hedge funds have been going short, and that usually can cause some problems here. All right, and then this is already outdated. I was going to include this with the RSI that I show later on, but we were getting quite overbought at this point. Now, it's not officially an overbought signal until it drops down below the red line, because this can stay up here for a while. Now, you'll look at the chart later on, and yeah, we have dropped back down. So now it's officially overbought as the RSI is now declining. And then quarterly capital raised by SPACs, and some of you might not know what they are. That's why I wanted to include the explanation here. Special purpose acquisition companies, they were all the rage back in 2020, 2021. It's like where if you get into an ETF or a mutual fund, you get into it because of what they're investing in. Well, very simply, a SPAC, it's like, here's a bunch of money, now go find something to invest in. And a lot of these have really flopped. They really dropped out of favor. And we're seeing a lot less money going into these right now. They can invest in pretty much anything that they find may increase in value. But as we were going up with the market, as we were getting more speculative, we saw statistics where people were getting into like tech stocks that haven't even earned any money yet. Because it's like, okay, I did all my value investing. I tried to find good investments. I've got some profits. I can buy some on margin here. Let's go and have a little fun with some of this more speculative company. And that's similar to what happens here. This is more speculation. You might make money doing this, but it might end up being a lottery ticket at the same time. Then the downward revision to payroll employment, it's the largest since 1979. Okay, other than April 2020. That was really weird too. But the downward revision, that's really what caused some concern in Friday's session. The unemployment rate, it says, if not for collapsing labor force since April, unemployment would have climbed to 4.9%. All right, fine. Okay. You have ARC here. For whatever reason, they would think the unemployment rate is a lot higher. Now, these are variations of charts. Now, if you belong to my website, I go through and I look at these charts pretty much after the employment report comes out, because a lot of these are employment looking here. And we're seeing some moves down, and I do a video there, but it's only available on the website. And I'll be doing that again as well once we get all the data in for these things to see. These are the things that the market looks at to say, all right, this is the NBR, the National Bureau of Economic Research. They're the ones who determine whether we're officially in a recession or not. And these are the charts that they look at, and you can find them on their website. Then the asset allocation. This is from AAII. These are individual investors. Most of them are still in stocks, where they've been languishing a little bit here with bonds and in cash. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, so here's the chart. Kind of scary looking. You just look at this. Thursday, when we opened, we were at the 64 up here. We were about 64.25, a little bit around there. We closed at 62.38 in Friday's session. That's a really big move over 2 days. But we set the high right at the open. Things were looking pretty good there. But then we drifted lower, and we've been seeing some of this weakness starting to build up. Now we're seeing it follow through as far as price. Then we did gap down. We never got down to S3 down here. That was lower than the price. But we came down. We finally were able to establish some kind of a base here, even though we dropped a little bit below it. But most of the move was really the gap and then the reaction right after the open. And then we just kind of sat here for the rest of the session and really came down. We were negative with the futures. We even went more negative as things started to develop. And then the reports came out. This kind of tan area, that's the cash session. And we didn't close much better than that going into the weekend. Now, this is still okay for right now. The blue line is still above the red line when we look at large cap growth versus value. Both were down, but value was down even more. And we're still okay here. If you take a bigger look, this was the big drop off that we saw on July 1st. Then we saw another drop off back around the latter part of July where value was outperforming growth. But if you look at this in the bigger context, we're still tending to go up. Now, if this continues to fall, that's going to change our evaluation of this chart. So growth was down, it got hit. Value got hit as well. Everything's red here. Now, the middle area, these are the ETFs. Like this is the SPY, and I believe this is the MDY, and this is the IWM. I think that's the middle area. That's the market itself. And then they break it out based on value and growth. And growth was down less actually for both the mid caps and the small caps. So these ratios are holding up for right now. They're still positive. When we look at small cap growth to value, mid cap growth to value, S&P growth to value, still holding up as well. This part hasn't changed. We're waiting to see if this sees more follow through. And we came down after just setting an all-time high with this growth to value ratio. And a little bit of a drop off here, but we're still positive when we look at discretionary to staples. And down, this is where we're turning more negative. You can see the red line is crossing above the green line. That's when we're negative. After hitting this 40 level, we're coming down, dropping below the moving average. That suggests a weakening trend in the short term, which usually happens before we see a change in trend, if that's what ends up playing out. We're also dropping below the moving average in the intermediate term, and you have to look at the numbers over here. But the green line is just a little bit below the red line, even though they're looks like they're kissing each other here. And we did really see a spike up in volume here, but it dropped off from Thursday was the big volume day. We saw not as much volume in Friday's session. Then sentiment, now this came out before everything started to go kablooey. This is the euphoria meter. This is another way of looking at sentiment, but it isn't updated as much. I like to look at sentiment charts that update periodically throughout the day, and that would be the Fear and Greed Index put out by CNN Money. But this is still giving us kind of a high reading here. We're back above 20 with the VIX, both on a closing basis, and the bar chart also went above 20. And this is what we've been waiting to see will happen. This is the seasonality of the VIX. And now this has not been updated for a few days, but this is typically for August, September, into the latter part of October, sometimes even a little bit into November. This is when the VIX tends to go up. That usually means stocks are going down. And we're also seeing an increase of the volatility of the VIX, well above the moving average, both with the bar chart and the line chart. And the skew index. All right, now it's really hard to make conclusions about this chart because we're not sure. The market is expecting some kind of a big move. Well, that happened on Friday, so we would expect this to drop. The fact that this is still a high reading means probably that a lot of folks were buying call options thinking we were going to break out, set new all-time highs, and everything was going to be great. That's why this is still kind of a high reading. But we don't really know at the time. They're just anticipating some kind of a big move. And this is where the VIX using the RSI based on 9 periods. We're already extreme with that reading. And I haven't shown this in a while because we've been just flatlining with the momentum of the VIX. That's starting to go back up as well, which is negative. We increased with this fear gauge, and we're pretty much flat here with this other fear gauge, which is strange. Usually both this chart and the previous chart, they tend to go up more in tandem with each other. And we actually saw a bit of a decline with the equity put call ratio, but this really went up big. It's like, okay, people were worried about Friday, so they bought a lot of calls to hedge and bought a lot of puts to hedge. Did I say calls? I meant puts. And then they ended up selling some of those puts in Friday's session. But when we take a 5-day average of the put call ratio, we're still going up with the 5-day chart as well as the 10-day chart. This is probably some of the smart money doing additional hedging, which is something that I teach all the time. You always should be hedged. I teach that in my program. And now this is what was causing some concern. The volatility risk premium, we were getting a very high reading here. We weren't seeing that in the VIX. We weren't seeing it with the other sentiment ratios that we look at, but we were seeing it here. And we were coming in at a very, very high reading. That dropped off with the decline that we saw. And so we're seeing some damage done to the advanced decline line based on price and volume, but still well above these advancing moving averages. We're back to below zero and declining with the advanced decline oscillator. In the short term, we're below zero, so that's negative with the advanced decline ratio. We're coming right down to but still barely positive with the intermediate term advanced decline ratio. Saw a bit of an expansion, and that's what we've been seeing over the last few sessions. The red is starting to grow. The green has been pulling back a bit, although the green's been outweighing it. The 5-day chart and the 10-day moving average chart are now starting to go down. That's more internally negative. And we're negative with all three of our smart money indicators. We actually dropped below the red line after Thursday. It's continuing to be below the red line after Friday. That's longer term. Shorter term, we use the boom indicator, which is just a modified MACD indicator. And we were seeing, as this was going up, the MACD boom indicator is what I call it, was actually going down. That's a negative divergence, and now we're seeing a drop off here with both of them. We're negative with the chicken money flow, histogram going down, red line going down. We're below the midpoint and declining with the chicken oscillator. So all three smart money indicators are now negative. Now we're still positive here, but showing some weakness. The vortex, it still has the green line above the red line, but the green line's really coming down as the red line's going up. And then again, this is not a true comparison here. We did decline with the S&P. We actually gapped down here, but we're seeing more weakness here with the NYSE advanced decline line, actually dropping back down below its 50-day moving average. And falling below the moving average with the NYSE common stock, still above the moving average with the S&P and mid caps, below the moving average with the small caps, and still negative here with those stocks in the S&P above their 20-period moving average. We dropped below 50 after Thursday. We're continuing to decline after Friday, and we're just barely negative here. This is intermediate term. This is some of the weakness that we're starting to see coming into the intermediate term trend. We did decline, but still above 50 with the 100 and 200-period moving average study. And we really came down here. We didn't quite get up to this pivot point here. That's the dashed line, and that's what makes this a useful tool is these lines. We already have them here for August and September are already being calculated here. And so these can be really helpful. We're already extreme negative now for the second day with the Stochk RSI. The Williams percent R, which just a couple days ago was extreme positive. Now it's going extreme negative. CCI 14 chart is extreme negative. We're declining below the midpoint, but not extreme with the CCI 20. And now we're below 50 and declining with the 20, 50, and we're still above 50 with the 200-day moving average study. And this is where we're seeing the mixed signals. The short-term stochastic, already extreme negative. Intermediate short-term, negative, but still above the midpoint. Coming down, it's negative, but still extreme here with the long short-term stochastic. And we're turning negative with the force index. And this is what I wanted to explain a little bit. These are Keltner bands, which are similar to Bollinger bands. They're moving average envelopes. And we were seeing how these lines were getting really close to each other. And sometimes after they've really been far apart, and then this is like winding up a spring, the more you wind it up, the tighter it gets. And when it finally gets let loose, we didn't know if it was going to break to the upside or to the downside. Right now, it looks like we're breaking more to the downside, and we're already down below the lower Keltner band. Seeing some damage now to the 20 period moving average. This is the short term. We're rolling over with the green line and the blue line. And now we want to keep an eye a little bit more. We're also going to be watching the 50 period moving average, but this is the 20 period simple and exponential. You notice as we finally started to come up out of those April lows, and even when we were pulling back, all of this was happening above the 20-day moving average. Why we're turning more negative now is we not only closed below the 20-day moving average, we opened below the 20-day moving average. And that was the high for the session. Now, we did close a little bit off of the low, but this is the first time since going back to April that we've been below the 20 period moving average. And now we're negative here with the standard deviations chart. Just a few days ago, we were up in the +3 channel. That's extreme positive. Now we're below the midpoint. Now we're in the -1 channel. But this is quite a switch. Where we were at +2 after Wednesday, we started out in the +3 on Thursday, came down, we're in the +1. Now we're dropping into the -1 area. Then we switch over to the intermediate term. Now we're still positive since we're above the 50-day moving average, but we are seeing some weakness. This is one thing that we were seeing here. We were going up with the S&P, but the balance of power was going down. That's a negative divergence, and now it's looking even more negative. I don't show this one very often. This is another momentum oscillator. It gyrates all over the place on a daily basis, but now we're getting an extreme negative reading. And this is strange, where it goes from more negative with the lighter blue to darker blue, back to lighter blue again. This will probably redraw. It's one of the reasons I don't really use this system all that much. I don't like things that readjust after things have happened. I need to see things more in real time. But this is switching back and looking more negative. We're also dropping below the midpoint. Now, we spent most of our time at the highest high value. That's the blue line as we've been going up. Now we're starting to threaten the lowest low value here, below the midpoint as well. This is another thing. Now, we're still positive according to the Landry Light. But when we got above this, we worked our way through July. When we get above 40, now this is more time. We're at 64 now. That just means that this trend has gone on for a long time. And so it's still positive for the time being, and it's still going up, but that could change if we see more weakness. We're still positive here with the proper order. And this is another negative divergence. We were going up with the S&P. The TTM squeeze was negative and declining. And we actually, for the first time in quite a while, we've been just dancing along barely positive here. With the ease of movement, we've actually dropped negative below the midpoint. Now, after Thursday even, we were extreme positive with the Arun. This tries to measure buyers in green, sellers in red. We dropped with the buyers, so we're no longer extreme. We're still positive with this, but that's how this indicator works. It can like do nothing for long periods of time and then suddenly just poof, it recalculates and comes up with a different conclusion. Now, here's the S&P McClellan oscillator. We're already below this -60 level. That means we're getting extreme negative. And we were seeing a negative divergence here. We were going up with the S&P. We were setting a lower high here with the McClellan oscillator. So when that's below zero, we decline with the summation index based on price and volume. That's negative. Now, we haven't gotten extreme yet with the NYSE McClellan oscillator, but it is below zero and declining. Also seeing the negative divergence. Now, this isn't a true comparison because this is the NYSE down here, comparing it to the S&P on top. But when that's below zero, the summation index for the NYSE based on price and volume are both declining. Swinging trading oscillator, that had been negative over the last few sessions, and it's still continuing to be negative. And we're below 50 and declining with the PMOs that are rising. We're not quite extreme yet here. The buy signals are below 50 and declining. And we're still getting a fairly high reading here with the PMOs above zero, but that is starting to decline as well. And we're still extreme positive with the PMO, but we're below the moving average and declining. And we're declining based on price and volume. We're negative with the Elder's Impulse system for the S&P, and now this is the parabolic SAR. We have a dot on top. That has switched from positive back over to negative. And we're no longer extreme with the slope oscillator. We finally dropped down below this green line, but it's negative because we're below the moving average. And we were improving. We almost went positive with the MACD. It came right up to its moving average. Now it's looking more negative. So then I put all of the different momentum oscillators here on one chart. We were seeing a divergence here where the slope oscillator was coming down. The TSI, the other short term, it was still going up. Well, now they're confirming each other where they're both declining. Then we have three intermediate term oscillators, the MACD, PMO, and PPO. Those are now going down. And then our two long-term oscillators, the TRIX and KST, they're starting to decline, no longer extreme with the TRIX, and also declining a little bit more with the KST. And then another momentum oscillator is the Copic curve. That was getting close, crossing back over positive, but it's now more negative. And really coming down here with the Sean trend meter. We were up into this dark green area. We fell down into the lighter green area. We're slicing through the even lighter green area here. We are declining, but still above 50 with the money flow, where we declined below 50 after Thursday with the ultimate oscillator. That's negative. Declining, but still above the moving average with on-balance volume. This is the RSI that I show. And earlier on, I showed you the Bloomberg version. I also base it on 14 periods. It had us up here with the chart that I showed you. Now we've dropped back down, and we're actually dropping below the midpoint. That's seeing some damage there because we've spent most of the time going back to late April above 50. That shows solid momentum. When we drop below 50, now things are turning more negative. Short-term RSI based on 9 periods, we're already well below the midpoint after just coming off of an extreme positive reading. Then this is kind of short and intermediate term together. We're dropping below, well below the green fluorescent moving average, the 10-day simple moving average. We're still above the 30-period exponential moving average, but now we've dropped below the 20-period exponential moving average. And this is called the bow tie method. This is still holding up, but showing some weakness. With the intermediate term trend based on 50 periods, we've dropped below both lines. Now the red line is starting to go over, and we're just possibly topping out here with the blue line. Now we spent time below the red line, but it still kept going up. Now that we're dropping below both, and if that still continues, it's going to turn the intermediate term trend more negative. So here are all the moving averages. We've been above the 20 periods. Now are we going to go down to the 50s? And see about testing that. We're no longer far away from the 20 or 50 period moving average. We use this like an oscillator. This is another way of using the boom indicator, which tries to measure price versus the moving average. And we were getting so far away there for a while, both in the short and intermediate term. Now that's working off. Bullish percent index, a completely different indicator. It's not an oscillator. It's not a moving average. This is declining below the moving average here. That's negative. We're declining and actually starting to turn negative with the NASDAQ 100 bullish percent index. Just 2 trading sessions ago, this was extreme positive. And we're declining, but still above 50 with the NYSE bullish percent index. Then I showed this for Friday's video where we come down just to the top end of this mini rainbow. This is a 20-period simple moving average of the open, high, low, close. None of this acted as support. This actually acted as resistance already. We opened above that and are well below the mini rainbow. And I just wanted to bring this up. We're still far away from these Fibonacci retracement levels, but now that we potentially have set a high here, I redrew that going back a little over a year ago. These were the April lows, and then extending it up to the all-time high. That's on an intraday basis. And we still have a ways to go. We'll have to break under 6,000, get into the 5,800s just to get to this retracement level. Then this is longer term. This goes back to the 2022 low to the all-time high, and we would have even more to go to get back there. This is a chart. We were a little bit concerned. We were getting pretty close to this R1 overhead resistance level. Didn't quite get there. We almost got there, but now we're dropping down. Now this is still looking okay for right now. Now, if we see more weakness from here, then it's going to not look very positive. But for the most part, we've been seeing higher highs and higher lows. Now, that appears to be threatened right now. And now we're turning more negative with the different ways that we look at the trend. The Heiken Ashi is now negative. The Kegi chart is still positive since it's black, but it's been pointing down. And we're showing a little bit of weakness here with the Renko chart with the red block. And we're negative with the 3-line break. And some of this we started to see after Thursday's session. And we did draw in some new O's here with the point and figure chart. This doesn't take time into account, just price. And the signal that we were working off of, the positive signal that was generated back in early June, that's now gone. So long term here, we're coming down. We were extreme with the 150. We're above this red line. Now we're coming down here. We're also seeing a decline with the 200-day moving average, but still above the midpoint. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So we're negative across the board on all different stock indexes, still positive in the intermediate and long term. And commodities have now switched to being negative in the short term. The dollar is still in a short-term uptrend. And bonds they really had a good day. They were up in the short and intermediate term, still negative in the long term. And we had healthcare, staples, and utilities. Generally considered to be defensive areas. They were up. Healthcare has been getting hammered. Staples have been really underperforming. Utilities, that's the one that you could make a case that they're a growth area. But historically, they've been a defensive area because they pay dividends. But because of all the need for electricity with AI and electric vehicles, you could make a case that's a growth area. But you see discretionary just got hammered. Tech, another growth area, got hammered. Communication, down over 1% as well. Awful lot of red. And the only green here was the euro going up against the dollar. Dollar didn't have a very good day, even though it's in a short-term uptrend. But we just had all these things. We were above 100 with the dollar. Now we're below it. Canada, which has been setting a series of all-time highs, not on Friday. The Dow crossed below 44,000. Then we have the S&P, which had been at 6,400, is now crossing below 6,300. The NASDAQ, you can just count down to blast off here. Below 21.1, 21, 29, 28, 27, 26. Then communication had a BPI cross below 70, and energy had a BPI cross below 70. Awful lot of red here. The green that you see, healthcare, and staples. These were the areas that saw some green. All of the growth areas that we usually follow, pretty stinking red. Hope you like Valentine's Day. And now this is what I was pointing out here with the Dow. We came down to this pivot point here, and it did come a little bit under its 50-day moving average, and that looks like a support level. But usually the bigger indexes, they don't necessarily key off of the Dow. So whenever we decline, I try to pick out, okay, why did we stop at that point? And I look at the other indexes, and sometimes we can get some clues from that. And we're negative with the diamonds looking at the Elder's Impulse system, a real drop off here below the pivot point with the NASDAQ, negative with the NASDAQ with the Elder's Impulse system, a big drop off here down almost 2% with the NASDAQ 100, not really hitting any support areas. We were watching this as possible overhead resistance, but we never got to that level. We're negative with the Elder's Impulse system for the Qs, momentum, which had been another negative divergence. This is the NASDAQ 100. It was going up and setting all-time highs. The PPO, which is a momentum oscillator, was actually declining. And another thing, this is a weekly chart of the NASDAQ 100. We came right up about to this trend line, and that's where things really started to slow down. We were going up, but we weren't seeing really big moves here, and now we're starting to drop below this trend line. And small caps, which had been above their 200-day moving average, nope, now they're down below their 50-day moving average with the S&P 600, right at the 200-day moving average with the Russell 2000 small caps, negative with the small caps with the Elder's Impulse system, just a little bit at its moving average with the mid caps, negative with the mid caps, but closing well up off of their highs, off of their lows. A big drop off here with the Wilshire 5000, a broad market measure, also a drop off here, but still above the 50-day moving average with the total U.S. stock ETF. And this is an area that we've been a little bit concerned about, not because of this chart, because we're on a pretty solid uptrend, but the financials came all the way down to their 50-day moving average. What's been concerning is that the financials have been underperforming the S&P enough to where we're getting really close to a death cross here with this ratio. And I usually say this, we want the financials to be strong. We want the banks to be doing well and insurance companies and all of the things that make up the financial sector. There's been some weakness that's been coming in here that you don't see in the chart itself. You only see it when you compare it to the S&P. And then the FANG index. These are the really big stocks, just coming off of setting an all-time intraday all-time high on Thursday, now falling 2.67%, falling below the 50-day moving average with Apple down 2.5%. Amazon, which came out and reported earnings, had a good report, but down below its 50-day moving average. Microsoft, which reported the day before, it really spiked up. It hasn't seen that price since. We've been dropping back down. Google also declined 1.44%. Meta, which was up 11% on Thursday, it gave 3% of that back on Friday. And Nvidia down 2.33%. Still looking okay when you look at the basic chart pattern, though. And Tesla, which has been all over the place, just up, down, crazy, like a roller coaster here. And Netflix was virtually unchanged. Now, it's been getting hammered here, and it dropped below its 50-day moving average, but it was the better looking chart as we were coming up from 2024 into 2025. But lately, it's been seeing more weakness, but not so much on Friday. And we're seeing more of a disconnect when we look at U.S. versus world stocks on a short-term basis, and we're declining with the longer-term correlation as well. Oil was down over 3%. It got hit with everything else. And the dollar came right back up, was getting above 100. Now it's back into the 98s. And we really dropped off here as far as the Truflation. Now, this is just a company. They do their own number crunching, and they come up with a number every day. They're coming up with 1.67%, where the last time we had CPI, just week before last, was 2.7%. And we did drop. This might have been a flight to safety, but we're really seeing interest rates coming down now, which could ultimately end up being positive for stocks. Didn't help them on Friday, though. And we really went up with the 10-year based on price. We're back to being inverted when we look at the 10-year to 3-month yield curve. And taking a bit of a hit here with Qs to S&P, coming down a little bit below its moving average. Discretionary to the S&P, that's been a weaker area. We ticked down a little bit here when we compare large cap growth to large cap value. So the large caps still above the moving average, declining but above the moving average with the mid caps, and coming back down to a rising moving average with the small caps. So our outlook, earnings season is still going on. Now we're beyond the big part for the S&P 500, but then there are companies that come out like Nvidia and all that. Everybody's all excited about that, but earnings season will still continue. And we're looking negative in the short term. We're still positive in the intermediate and long term, but weakness is now starting to come in. We're going to get factory orders on Monday, and that's it. And then any other stuff that develops over the weekend as far as the trade deals, any tariff announcements. Now, the deadline has come and gone, and what I saw said it's not going to be extended. Now, they did push it out a little bit for Mexico, but that's because they're talking. If these countries aren't doing any talking with the current administration, they're probably not going to get any kind of a delay there. All right, and then here's the economic calendar. It's a lot lighter, but still some important things coming out in the upcoming week. We're going to get the ISM services on Tuesday, and then the mortgage application, we get that every week. And then we'll get productivity and unit labor costs on Thursday, and then every week we get the initial claims and continuing claims. There's no economic reports coming out on Friday. Here's another look at another economic report calendar. Seasonally, when we look at August 4th, and here's a mistake, it should be August, well, actually no, because they send the book to print about July. So we're neutral to negative with the Dow, where we're neutral to positive with the S&P, but neutral to negative. So not much of any kind of a lean either way when we look at seasonality for August 4th. And then here's the new month here, where we're supposed to see a little bit of a bounce during a post-election year, but then we see some more weakness. And this is the negative seasonality that I've been talking about. And if you go back to 1950, during post-election years, they're all negative. Is that going to happen this time? And here's another newer chart where during post-election years, that's when we see most of the negative action is in August. And also the summer rally, even though it's positive, it's the least best of the rallies that have occurred over a period of time. And when you go back to 1950 during post-election years, we're up 8 out of 18 times. We're down 10 out of 18 times with a negative return of 1.2%. This also, and after this video, I'm going to throw these over into the weekly video, where typically we start getting into August. This is about when we top out here. This is not completely up to date, but then we see a little bit more of a weakness as we come down that can, these historically has lasted until we get into November. All right, so we have our three smart money indicators are negative. Our McClellan oscillators and summation indexes, both for the S&P and NYSE, are negative. Swollen trading oscillator, the parabolic SAR, both the 20 and 50 period moving average studies are negative. The bullish percent index is negative. The oscillators are negative. Ease of movement is now negative, as is the ultimate oscillator, and the momentum for the NASDAQ 100 is negative. And then I'll go over this in the weekend videos. We have a long-term oscillator that continues to be negative, which was improving. We'll see if it hasn't still trying to improve there. And then we have a very long-term sell signal from the Zohorchak method that got triggered a few weeks ago. On the positive side, we're still looking okay with the growth to value and discretionary to staples ratios. And I don't put moving averages on these. The NASDAQ 100 and NYSE bullish percent indexes, they're still above 50. If you had a moving average on there, it would probably be negative because they are declining. Money flow, vortex, those are still positive, but all of these are showing weakness in the financial sector. We're still concerned that it's underperforming the S&P. Here are the pivot points for Monday's session, which are available on the YouTube community tab as well as the website. So our conclusion, we're changing this a little bit now. We're positive still in the intermediate and long term, but weakness is developing. In the short term, we're negative and still showing some weakness there. Intermediate term, still positive, but weakness is developing, but we're still positive in the long term. Not seeing a lot of damage there, at least yet. Thank you. I hope you found this helpful. Have a wonderful weekend, and I will talk to you in the next video.